Welcome to Zap Podcast. In mid-August, major funds successively released their 13F quarterly reports, disclosing their holdings as of June 30th. Let's briefly explain what a 13F is. It's a mandatory quarterly disclosure document required by the U.S. Securities and Exchange Commission for funds with assets under management exceeding $100 million. Funds must submit it within 45 days of the end of each calendar quarter, including information on U.S. listed stocks, call or put options, convertible bonds, and specific ETF positions held at the end of the previous quarter. Because of the time lag in disclosure, 13F reports aren't suitable for direct copying, but they remain the most direct window into the investment strategies of leading funds, especially the consensus and disagreements among different funds, which may hold clues to future market trends. This time, we'll be looking at 7 funds, from Buffett and Berkshire Hathaway to Druckenmiller, Duan Yongping, Li Lu, Cathie Wood, Dan Bin, and Leopold Aschenbrenner's situational awareness. Let's start with Berkshire Hathaway. As of June 30th, Berkshire Hathaway disclosed 29 holdings in its 13F filing, including 1 new position, 7 increased holdings, 6 reduced holdings, and 1 sold off, with a nominal market value of approximately $299.3 billion. This is the second 13F filing since Warren Buffett stepped down as CEO and Greg Abel officially took the helm, and it marks Berkshire's first significant net buying quarter after ending 14 consecutive quarters of net selling of stocks, with net purchases approaching $20 billion. Berkshire's holdings remain highly concentrated, with the top 10 holdings accounting for approximately 88.47% of its total portfolio. Apple, with approximately $65.95 billion, firmly holds the top spot with a 22.0% weighting in the portfolio. American Express, with approximately $51.28 billion, accounts for 17.1%. Alphabet, with approximately $37.76 billion, includes approximately $28.16 billion in voting shares of Google and approximately $9.61 billion in non-voting shares of Google, placing Google among the top 3. Coca-Cola, with approximately $32.51 billion, accounts for 10.9%. And Bank of America, with approximately $27.54 billion, accounts for 9.2%. Chevron, Occidental Petroleum, Chubb, Moody's, and Kraft Heinz rank 6th to 10th, respectively. Structurally, Berkshire Hathaway has not significantly changed its core portfolio framework of consumer goods, financials, and energy, but the addition of Google has significantly increased the weighting of technology stocks in the portfolio. The most noteworthy move in the second quarter was its large bet on Alphabet. Berkshire Hathaway increased its holdings of Alphabet Class A shares, GOOAL, by approximately 24.54 million shares, a 45.2% increase. Simultaneously, it increased its holdings of Class C shares, GOGE, by approximately 23.6 million shares, a dramatic 658.3% increase. The combined increase of approximately 48.1 million shares made Google a top 3 holding. Besides Alphabet, Berkshire also significantly increased its holdings in Delta Airlines, Liner Construction, and Macy's. Reductions were primarily concentrated in the financial, consumer, and cyclical sectors. Bank of America reduced its holdings by approximately 30.23 million shares, a 5.9% decrease, marking the second consecutive quarter of reductions. Capital One reduced its holdings by approximately 58%, Kroger by approximately 22%, and Ally Financial, DaVita, and Nucor also saw declines. This can be interpreted as a subtle style shift under Abel's leadership at Berkshire Hathaway, with the clearest signal in the second quarter being a shift from traditional financials and consumer goods towards technology growth. The significant investment in Google not only breaks the stereotype of Buffett avoiding tech stocks, but also reflects the new management's deep recognition of Google's competitive advantage in AI and search. Essentially, it's a classic case of value confirmation rather than trend chasing. However, Berkshire Hathaway's core focus remains unchanged. The holdings of its ballast stocks like Apple, American Express, and Coca-Cola have remained largely unchanged, and its energy sector holdings of Chevron and Occidental Petroleum haven't been sold off. The decrease in their percentage holdings is mainly due to dilution from new acquisitions. Overall, Berkshire Hathaway's portfolio adjustment this quarter followed the logic of heavily increasing holdings in leading tech companies, structurally reducing holdings in financial and consumer goods, maintaining its core energy sector, and tentatively expanding into real estate and aviation. Next, let's look at Druckenmiller. While not as famous as Buffett and Berkshire Hathaway, Stanley Druckenmiller is perhaps the most noteworthy fund manager on Wall Street today. He served as the chief investment officer of the Soros Quantum Fund from 1988 to 2000 and is one of Soros's most successful fund managers. His most crucial role now lies in the fact that current U.S. Treasury Secretary Scott Bessent and Federal Reserve Chairman Kevin Warsh both have mentorship or long-term working relationships with him. Therefore, compared to Berkshire Hathaway's more long-term oriented 13F filings, Druckenmiller's family office, Duquesne Family Office, presents its quarterly reports more like a macro trading map, especially given the rapid changes in AI, interest rates, and the U.S. economic outlook. As of June 30th, Duquesne Family Office disclosed a total of 95 holdings in its 13F filings. During the quarter, it added 48 stocks, increased holdings in 16, reduced holdings in 11, and liquidated 23, with a nominal market value of approximately $5.21 billion, a significant increase from $3.38 billion in the previous quarter. The top 10 holdings accounted for approximately 45.8% of the total. Genetic testing company Natera remained the largest stock holding at the end of the second quarter, with approximately 3.19 million shares, valued at about $865 million, representing about 16.6% of the portfolio. The second and third largest holdings were TSMC and ST Microelectronics, accounting for approximately 5.4% and 4.4% respectively. Other stocks in the top 10 holdings included Insmed, both stock and options, YPF, Argentina's state-owned oil company, and Amazon. The most noteworthy change for Duquesne in the second quarter was its portfolio rebalancing within the AI industry chain. It completely liquidated its positions in Micron, Broadcom, and Intel, with Broadcom being a newly established position from the first quarter. However, this did not mean Druckenmiller abandoned semiconductors. Instead, he continued to increase his holdings in TSMC and ST Microelectronics and established a new position in AMD. Simultaneously, he extended his reach to the periphery of AI infrastructure, buying into Bitcoin mining companies like Hut 8, BitDeer, and Riot Platforms, which are transitioning to data center operations. It appears that Druckenmiller is realizing profits on some of its larger performing positions while shifting funds to what it perceives as better risk-reward ratios. Furthermore, in the second quarter, it repurchased Alphabet, which it had just liquidated in the first quarter, and significantly increased its Amazon holdings, which it had reduced in the first quarter. This move may be a bet that the large companies previously bearing significant AI capital expenditures will gradually transform from payers for AI infrastructure to beneficiaries of AI commercialization. Interestingly, Duquesne, like Berkshire Hathaway, is bullish on airlines, establishing a new position in Delta Airlines and increasing its holdings in United Airlines. More notably, in the second quarter, it re-established a position in Baidu ADRs by approximately 88,000 shares, marking the first time in 2.5 years since the fund liquidated its Alibaba holdings at the end of 2023 that it has reheld US-listed Chinese stocks. In short, Druckenmiller hasn't left AI, rather it's reselecting the winners of the next phase of AI development. At least judging from his holdings at the end of the second quarter, he still maintained a fairly complete exposure to AI, only reallocating some of the highly concentrated hardware components towards cloud platforms, data centers, and AI applications. His position in Baidu is not large, but it indicates that his focus on Chinese technology assets is rebounding. Next is H&H International Investment, managed by Duan Yongping. Duan Yongping's holdings remain highly concentrated, but in the second quarter, there were signs of a return from some overvalued tech stocks to Chinese internet companies listed in the U.S. As of June 30th, H&H International Investment disclosed a total of 18 holdings in its 13F filing, with a nominal total value of approximately $19.101 billion, equivalent to approximately RMB 130 billion, a decrease from approximately $20 billion at the end of the first quarter. It should be noted that the 13F filing only discloses long positions in U.S. stocks, so Duan Yongping's holdings in Tencent, Popmart, Quichao Matai, and other assets, as well as a large number of put options transactions for premium collection, are not included in this filing. H&H's holdings are highly concentrated, with the top 5 holdings accounting for over 88% of its portfolio. Apple, at approximately $7.841 billion, 41.05%, remains the largest holding. Berkshire Hathaway Class B shares, at approximately $4.618 billion, 24.18%, together with Apple form a ballast. Pinduoduo, at approximately $1.91 billion, 9.99%, has jumped to become the third largest holding, signifying a significant increase in the weight of Chinese internet companies in Duan Yongping's portfolio. Tesla, at approximately $1.42 billion, 7.44%, and Nvidia, at approximately $1.26 billion, 6.58%. In the second quarter, H&H's most significant move was a substantial increase in its Pinduoduo holdings, adding 5.2738 million shares, a 26.71% increase, making it the third largest holding. Simultaneously, it slightly increased its holdings of Berkshire Hathaway Class B shares, which can be interpreted as a long-term commitment to the underlying framework of value investing. In addition, Alibaba, which had just sold off its entire stake in the first quarter, bought back 301,400 shares in the second quarter, worth approximately $28.93 million. Regarding reductions in holdings, AI and leading technology companies were the main targets for profit-taking. Nvidia saw a reduction of 7.5631 million shares, a significant decrease of 54.63%. Google saw a reduction of over 1.7 million shares, a decrease of 46.88%. Microsoft saw a reduction of 25.78%. Apple saw a reduction of 1.8469 million shares, marking the second consecutive quarter of selling, following a reduction of 3.4129 million shares in the first quarter. TSMC and CrowdStrike were completely sold off. However, Duan Yongping is not simply bearish on these tech stocks that saw reductions in holdings. In late July, he publicly stated that he would add some Google shares and continue to look for opportunities to buy Nvidia at lower prices through put options. In other words, the reductions were more based on judgments of price and safety margins, rather than a rejection of the companies themselves. To summarize this 13F statement in one sentence, sell a little when prices are high, buy a little when prices are low, and continue to hold good companies. Apple and Berkshire Hathaway remain core holdings, but after continuous reductions, the number of Apple shares has decreased for 2 consecutive quarters. Pinduoduo has become the new third largest holding, and Alibaba has also returned to the portfolio. While Nvidia and Google saw reductions, it wasn't due to a bearish outlook, but rather a strategy of realizing profits and then potentially buying back at a lower price. Next is Lilu's Himalaya Capital. Similar to Duan Yongping, Lilu also significantly increased his holdings in Pinduoduo in the second quarter. As of June 30th, 2026, Himalaya Capital disclosed a total of 8 holdings in its 13F filings, increasing holdings in 2 and liquidating 6. The number of holdings decreased significantly from 14 in the first quarter, but the total nominal value of holdings increased from $3.201 billion in the first quarter to $3.703 billion. The portfolio has further contracted and concentrated, with the top 5 holdings accounting for a combined 94.77%. Himalaya Capital's current 8 holdings present a pattern of Google as a ballast, Pinduoduo as a leap forward, and financials as a foundation. Google, with a total of approximately $1.775 billion, accounting for 47.64%, remains a long-term ballast held since its inception in 2020. Pinduoduo, with approximately $821 million, accounting for 22.17%, has become the second largest holding after a significant increase. Berkshire Hathaway Class B shares, with approximately $555 million, accounting for 14.98%, continue to be increased. East West Bank, with approximately $358 million, accounting for 9.68%, remains unchanged. Additionally, Crocs 2.90% and Tencent Music 1.50% also remain unchanged. Apple, however, is only held as a small undisclosed position at 0.88%. In the second quarter, Himalaya Capital only increased its holdings in 2 stocks, completely liquidating its remaining 6 existing positions, a level of decisiveness in portfolio adjustments rarely seen among top funds. Pinduoduo was a major focus of increased holdings, with an increase of 6.1531 million shares, a surge of 133.53%, bringing the total holdings from 4.608 million shares to 10.7611 million shares. At the end of the quarter, its market value was approximately $821 million, making it the second largest holding. Berkshire Hathaway Class B shares saw an increase of 23.46%, effectively entrusting more funds to Buffett and Abel for management. Meanwhile, Himalaya Capital completely exited 6 holdings in one go, including Bank of America, Occidental Petroleum, S&P Global, Moody's, MSCI, and H&R Block. This represents Lilu's decisive withdrawal from traditional finance, index data services, and the oil and gas sector. Bank of America, in particular, was once one of his core holdings, but this time he chose to completely sell off his entire stake, rather than making a small reduction like Berkshire Hathaway. If Lilu's second quarter operations could be summarized in one sentence, it would be a significant reduction in positions outside his circle of competence, further concentrating limited funds on a few companies he truly understood. While maintaining a significant stake in Google, he also increased his holdings in Pinduoduo, representing his long-term assessment of leading U.S. technology companies and Chinese internet assets, respectively. His liquidation of financial, energy, and index service-related stocks signifies a further reduction in his portfolio. Of course, similar to Duan Yongping's situation, the 13F filing only discloses eligible securities in the U.S. market. Hong Kong-listed assets like BYD, Postal Savings Bank of China, and CRRC will not appear in this 13F filing. Next is Cathie Wood, known as the female Buffett and nicknamed Sister Wood, and her ARK investments. As of June 30th, ARK disclosed a total of 191 holdings in its 13F filings, including 15 new positions, 78 increased positions, 96 reduced positions, and 6 liquidated positions, with a nominal total market value of approximately $15.4 billion, a significant increase of over $2 billion compared to the first quarter. The portfolio adjustments in the second quarter were quite aggressive, very much in line with Sister Wood's typical high turnover style. ARK's top 10 holdings accounted for 39.45% of its portfolio, a relatively moderate concentration, but the core asset portfolio exhibited a relatively high risk appetite. Tesla, at approximately $1.161 billion, 7.5%, remained the largest holding, but has been reduced for the third consecutive quarter. AMD, at approximately $820 million, 5.3%, is a core holding in the AI computing power sector. SpaceX, at approximately $765 million, 5%, was a new addition this quarter and immediately entered the core holdings. Tempus AI, at approximately $580 million, 3.8%, focuses on precision medicine and AI diagnostics, and Robinhood, at approximately $525 million, 3.4%, serves as a gateway to fintech and the retail investor ecosystem. In the second quarter, ARK's most crucial move was its IPO rush of SpaceX shares. On June 12th, SpaceX's first day of trading, multiple ARK ETFs collectively purchased approximately 3.29 million shares, rising to 4.478 million shares by the end of the quarter, with the SPCX's weight in the portfolio reaching nearly 7% at one point. Besides SpaceX, ARK's investment portfolio also showed significant vertical expansion across the industry chain. The newly established position in Cerebras Systems represents a bet on AI computing architecture. Increased holdings in Google strengthen its exposure to platform-based AI. Purchase of X Energy indicates early positioning in nuclear energy as a baseload power source for the AI era, and additional holdings in Eli Lilly reinforce the life sciences theme. On the reduction side, the most noteworthy is the reduction in Tesla holdings for 3 consecutive quarters, which may indicate that the fund manager believes Tesla's relative position in the AI narrative is declining. Overall, ARK maintains a relatively high-risk appetite among top funds, with disruptive innovation remaining its most favored theme, spanning AI computing power, aerospace, nuclear energy, and life sciences. Next is Dan Bin's Oriental Harbor Overseas Fund. This 13F report can be described as quite aggressive, not simply adding or removing a few stocks, but almost completely refactoring its AI holdings. As of June 30th, Oriental Harbor Overseas Fund disclosed 13 holdings in its 13F filings, including 7 new positions, 1 increased holding, 5 reduced holdings, and 6 liquidated positions, with a nominal total holding value of approximately $1.65 billion, an increase of approximately 45.6% from approximately $1.133 billion in the first quarter. The top 5 holdings of Oriental Harbor Overseas Fund accounted for approximately 73% of the portfolio, further increasing the concentration of holdings. Moreover, AI hardware and semiconductor industry chain-related stocks now account for more than 70% of the portfolio's weight. Google, at approximately $371 million, accounting for approximately 23%, remains the largest holding. Intel, at approximately $258 million, accounting for 16%, a new addition in the second quarter that jumped to second place. Nvidia, at approximately $217 million, accounting for 13%, slipped from first to third. SanDisk, at approximately $176 million, accounting for 11%, a new addition that ranked fourth. And Micron, at approximately $170 million, accounting for approximately 10%, saw its holding more than double. The 6th to 10th positions are held by AMD, 8.9%, Marvell, 7.9%, TSMC, 4%, ARM, 3.2%, and Broadcom, 1.5%. Aside from Google, 9 of the top 10 holdings belong to the AI computing infrastructure or semiconductor supply chain. The sell-the-shovel hardware logic has completely replaced the previous strategy of heavily investing in software platforms. This quarter, Oriental Harbor Overseas Fund launched a saturation attack on the AI hardware supply chain, adding 7 new related stocks: Intel, SanDisk, AMD, Marvell Technology, ARM, Broadcom, and Lumentum, all targeting computing chips, storage, optical communications, and upstream semiconductors. Intel directly entered as the second largest holding, while SanDisk and AMD also entered the top 6 holdings, clearly indicating a strong intention to increase investment in the storage sector. While fully embracing hardware, Dan Bin also decluttered his existing holdings. Nvidia, TSMC, and Amazon all saw reductions in holdings. While Google remains the largest holding, it was reduced by 155,200 shares compared to the first quarter, and the ETF with a 2x leverage ratio in Google was also liquidated, resulting in a significant decrease in overall weighting. Additionally, Oriental Harbor Overseas Fund liquidated all its holdings in Apple and Tesla, 2 leading consumer electronics companies, potentially indicating a lack of confidence in a short-term recovery in the consumer market. It also liquidated its holdings in stablecoin issuer Circle. Overall, Dan Bin remains betting that AI capital expenditure will continue to flow into the hardware sector. While the market is still debating whether AI has a bubble, his judgment is that the hardware segment, which sells shovels, remains the most certain direction. This aligns with his recent public statements, in which he still believes AI is the super theme for the next decade, and the market has not yet fully grasped its long-term potential. At the end of July, when storage stocks experienced a sharp correction, he even boldly declared, "You must dare to buy on big dips. I've used up all my remaining ammunition." Finally, there is Leopold Eschenbrenner's Situational Awareness LP. Due to its outstanding performance in the past few quarters, its 13F filing was once highly anticipated by the market. However, it's regrettable that this fund had just experienced its darkest moment at the end of July. A sharp correction in AI-related stocks, coupled with high leverage, resulted in significant losses for the fund, forcing it to liquidate a large portion of its open market holdings and sell most of its stock portfolio at a discount to Ken Griffin's Citadel. Analyzing Situational Awareness LP's 13F report reveals an even more regrettable story. At the end of the first quarter, this fund constructed put options with a notional value exceeding $8 billion in chip and memory leaders, covering semiconductor ETFs such as SMH, Nvidia, Oracle, Broadcom, AMD, and ASML. These positions could have effectively hedged against the market downturn, but because it prematurely shifted to a fully bullish stance, Leopold Aschenbrenner dismantled this safety net, ultimately allowing Ken Griffin to reap the rewards at a discount. Looking at the 13F reports of these 7 funds together reveals a relatively clear consensus. AI remains at the center of attention for top investors, and funds are significantly repricing the AI industry chain. The continued growth of AI seems inevitable. The question is who will truly turn investment into profit in the next phase. Berkshire Hathaway has begun a major acquisition of Google shares. Druckenmiller is rotating within the semiconductor sector and rebetting on cloud computing and AI infrastructure. Dan Bin is even more aggressive, significantly shifting his overseas portfolio towards chips, storage, and optical communications. ARK continues to seek next-generation growth assets along the lines of AI, SpaceX, energy, and life sciences. Meanwhile, Duan Yongping and Li Lu haven't simply chased the AI hype, but after reducing their holdings in some of the more significantly appreciating tech stocks, they've reallocated funds to assets they are more familiar with and believe offer a higher margin of safety. Simply observing the 13F filings of various funds makes it difficult to deduce a clear next big winner, but the fund movements of different funds are themselves a rotating game of AI investment logic. GPUs, chips, storage, networks, optical communications, data centers, power, cloud computing, commercialization, from selling shovels to providing computing power, and ultimately sharing the commercial dividends of AI, funds are constantly searching for the next profit-making point in the AI value chain. It needs to be emphasized again that all these holdings are as of June 30th, 2026. 13F filings inherently have a disclosure lag of up to 45 days, especially for investors like Druckenmiller and Dan Bin, who adjust their portfolios quickly. Rather than treating it as a copycat list, it's better to see it as a snapshot of how different funds interpret the next phase of the market. If you also manage multiple wallets, DeFi positions, and portfolios, you can visit the Zap Pilot website to make portfolio management simpler and clearer.